Good afternoon from Athens. My name is Nikos Vettas. I'm the General Director of ΙΟΒΕ, the Foundation for Economic and Industrial Research, and Professor at the Athens University of Economics. This is an event that is jointly organized with the Konrad-Adenauer Foundation. And first of all, I would like to convey to everybody the greetings of its director, Henri Giscard-Bonnet. For those who have been following us, this is actually a sequel to a discussion that we had physically in Athens. If I'm not mistaken, this was the beginning of February, before COVID-19. But we all thought that this is such an interesting time to discuss policy in Europe. Certainly monetary policy that appear to take the lead at some point, the interrelation with fiscal policy, then through the banks and the real economy. All these are open questions, and policy has to shape how our future is going to be for the next couple of years at least, and probably longer run. So I'm not going to say anything else. I'm going to jump into the discussion. We are honored to have three distinguished gentlemen with us this afternoon. The floor is first going to be given to the Vice President of the European Central Bank, Luis de Guindos. Then to the Finance Minister of Greece, Christos Staikouras. Finally, to the Governor of the Bank of Greece, Yannis Stournaras. They will each make some initial introductory remarks for whatever they think is important right now. And then we're going to get into a discussion that is going to touch upon those issues, but also some additional. Those of you who are following us live through the YouTube channels, you can actually write down in the chat option questions, and I will try to blend them into the discussion if possible. So with no further delay, Vice President, the floor is yours. So how do things look from Frankfurt these days?
Well, first of all, good afternoon to everyone from Frankfurt. Let me say that it's a pleasure to share, this seminar, this webinar, with my good friends Christos and Yannis. But I hope that the next time we will be able to do it physically in Athens. I would prefer that format, and I hope that we'll be able to let these webinars behind us, despite the fact that for sure we are going to travel a little bit less, after the pandemic is over. And I will refer rapidly to three issues in my initial remarks. The first one will be the outlook and the economic forecast, how we do see the situation, the economic situation, and the potential short-term evolution of the European economy. The second one will be, the policy response. I will make some comments on the policy response. Today is a good day for Europe because the recovery fund and the package has been approved by the European Council. So this is good news. And finally, I will also make some comments on the financial stability situation in Europe, and mainly focus on the profitability of banks and the impact that the pandemic could have or might have, is going to have in the profitability of the European banks. Starting with the outlook, well, that we produced 1 month ago our projections. Our baseline scenario is identical to the baseline scenario, to the central scenario of the European Commission. It's a decline in GDP of 9%. And, because of the level of uncertainty that is huge, we have two alternative scenarios. One that is not very probable, that is a benign scenario with a decline in GDP of 6%, and, a more severe, a worst case scenario with a drop that, is in the area, decline in GDP in the area of 12%. But I think that, here are our projections, embedded in our projections. And if you look at our our quarter-on-quarter profile evolution of the European economy, what we are projecting is a drop in GDP quarter-on-quarter in the second quarter in the area of 13%. And the high frequency information that we have received indicates that perhaps it will be slightly better than this 13% decline in the second quarter. But the level of uncertainty is huge. We expect a recovery in the third quarter and the fourth quarter. But I think that there are two elements that are going to mark the evolution of the economy over the next 2-3 quarters. The first one is the pandemic. The possibility of a second wave is going to be an important impact. And I think that as well, the evolution of the pandemic all over the world. We have seen that the news from the United States are not good, as well from Latin America, from some parts of Asia. And this is going to have a negative impact on the evolution of the world trade. Our projection is that global trade will be declining a little bit above 10% in 2020. And for sure that for the external demand of the euro area countries, this is something that is going to be quite relevant. The second element that in my view is going to shape the recovery over the next quarters is the evolution of the labor market. So far, we have seen that the dynamics of the labor market do not reflect the important drop, the important decline, and the collapse of GDP. And this is because the furlough schemes, the short-time labor schemes are encapsulating the evolution of the labor market. So it's much better to look at the number of hours worked as an indicator of the potential evolution of the labor market, despite the fact that employment is always a lagging indicator in comparison with activity. And our projection is that in the second quarter of the year, the number of hours worked will be reduced to, something in the area, a range between 10 and 13%. And this is a much clearer indication of the potential impact of the real impact that the collapse in activity, that the slump in activity is having in the labor market. So I think that these two factors are going to be the main drivers of consumption. We have seen an important increase in the saving ratio all over Europe. I think that a part of this increase in the saving ratio has been driven because of the confinement, of the lockdown of the economy. So it has been a forced saving. But there is another part of saving that perhaps has to do much more with precautionary reasons. And, in the case of the forced saving, this is going to give rise, it will be transformed into consumption once the economies are open. But the precautionary, drivers behind the increase in the saving ratio is something that, it will take much more time to be transformed into consumption. With respect to inflation, our projection is that over the next months, taking into consideration the evolution of oil prices and some VAT rebates that we have seen, for instance, in the case of Germany, that is going to be a temporary, one-off VAT reform reduction for 6 months. I think that are going to have a negative impact on the evolution of the headline inflation. They are going to reduce further the evolution of inflation. But in the medium term, I think that we are going to have two opposed forces. On the one hand, the pandemic and the slump in demand that is going to continue, pushing the inflation rate down. On the other hand, the disruptions in the global supply chain could give rise to forces, that are opposed to the slump in demand, and that could give rise to increases, in the inflation rate. So that's with respect to the outlook. A lot of uncertainty, a lot of question marks. The evolution of the pandemic, that is an exogenous variable for economists, but I think that is going to be a very important element. And as well, the possibility of having, a solution, a remedy to this pandemic. I think that the discovery of a vaccine is something that is really having, is one of the drivers of the evolution of the markets. So all these questions are going to be relevant in order to understand the evolution of the economy and the evolution of markets. And finally, for sure that the policy response is the other element that we have to take into consideration. Policy response that has been very rapid, that has been quite intense, that I think that this policy response has nothing to do with the response that we had in the previous crisis. From the monetary policy stance, our policy stance was based on three pillars. The first one is liquidity to the banks, for the banks. The second one is an expansion of our purchase programs, and finally some modifications of the capital requirements, liquidity requirements, provisioning requirements of the banks in order to help banks to continue lending to the economy. I think that the outcome of these policies so far has been quite positive. Markets are much calmer than they were only 3-4 months ago. Now even we can see that in certain areas, in certain segments, the situation is similar to the one that we have pre-corona, and I think that this policy is working. And finally, let me say something with respect to fiscal policy. Fiscal policy has to play a very important role in this crisis. We had a very rapid response at the national level. Governments started to implement expansionary and stimuli programs from the fiscal side. But the problem is that not all the countries have a similar fiscal space. So that's why the joint common response from the European Council, the program that has been approved last night, I think that is very good news. That will level, in the possibilities and the possible actions in terms of fiscal policies from different countries. And simultaneously, it sends a very clear message that Europe is united, that for the very first time we are going to have issuance of joint debt, that I think that is a very positive signal, and that this package is going to be positive, not only in terms of the fiscal action, but as well in terms of the political message that we are conveying to the markets. And finally, let me say something with respect to financial stability. We had some issues before Corona. That's something that is quite obvious. Perhaps the main one that I want to focus my attention is on the profitability of banks. Profitability was very low. You know perfectly that the return on equity of the European banks was clearly below the cost of capital demanded by investors. That gave rise to very low valuations, price to books that were clearly below what happened in other parts of the world in comparison with the American banks or the Nordic banks. And I think that it was one of the main problems that we had, before even, the arrival of the pandemic. But now, with the pandemic, it's going to be it's going to have an additional impact on the profitability of banks. So what it was needed before Corona, that was consolidation, was restructuring, was the reduction of costs, to improve, the revenue flows of the banks, is going to be more and more relevant, more and more needed now. We believe that consolidation could be, an instrument in order to find, this, improvement in the profitability situation of the banks, in order to get rid of excess capacity, to reduce costs, to capture economies of scale and scope, and this kind of things. So these are the comments that I wanted to make. I think that perhaps even I am taking too much of time, even beyond the 10 minutes that I promised. So I would pause here.
All right. Thank you very much. We will come back to lots of these issues, obviously, in the discussion. But if I'm not mistaken, you portrayed a reasonably optimistic view about where we are. But let me turn to Minister Staikouras and have his first thoughts. I guess focusing also a little bit more on Greece, but also through the European framework. First of all, how did the news look from this early morning?
I think we have a sunny day for Europe and for Greece. But let me start by thanking the organizers, ΙΟΒΕ and Konrad-Adenauer-Stiftung, Greece and Cyprus, for their kind invitation and their initiative to hold this thought-provoking e-discussion. It's a great pleasure to share the floor with good friends and colleagues like Luis, and Yannis. This pleasure becomes even greater today, since the discussion takes place just a few hours after the positive, bold, ambitious EU summit's decision on the recovery fund. Before elaborating more on this, I have to underline that Europe's response, as Louis mentioned before, to this unprecedented, exogenous, and symmetric crisis has been prompt and dynamic, in contrast with the financial crisis a decade ago. Important decisions were taken, and both fiscal and liquidity boosting measures were activated. Just to pick up some of them, fiscal rule,
Christos, δεν ακούμε. Όχι. No.
We lost count temporarily.
Όχι. Όχι.
do you hear me?
Yes.
Yes.
Okay, so I will start from the beginning or from where? Okay, so just to pick up some of the policies, as I mentioned before, fiscal targets, rules, and requirements were lifted. The framework for state aid and public procurement became more flexible. The ECB has introduced the PPP and has adopted a package of temporary collateral easing measures. And Europe activated a safety net for states, employees, and businesses through the ESM pandemic crisis support, the SURE program to subsidize employment, and the pan-European EIB guarantee fund to strengthen business liquidity. And finally, after the agreement reached in the EU summit marathon, the recovery fund is added to our armory. It is true that this agreement is the fruit of compromise. We all know that Europe makes its way step by step through compromises. However, the final decision is ambitious, flexible, realistic, rational, fair, and in line with the challenges we are facing. It is mainly based on grants rather than loans. It gives every member state the opportunity to draw its national strategy. It includes common borrowing, and it emphasizes on sectors that are important for Europe's future, such as digital transformation and green development. If we add the decision that was taken yesterday with the safety net created a couple of months ago, the total amount stands at about 1.3 trillion.
I think we are having some problems with the connection with the ministry, but I think now we have the minister back again.
Yeah, but let's hope for not for,
Okay.
for more.
Some forbearance.
Just the final comment, I think, was quite important in order to have an idea of where we stand. If we add the total amount that was decided yesterday with the decision that was taken a couple of months ago regarding the safety net for states, enterprise and employees, they amount to 1.3 trillion euros, more than MFF for the period 2021-2027. The Greek government stands ready to make the best use of the recovery fund. It is already working swiftly and efficiently on the continuous implementation of its national reform agenda, even under the difficult circumstances created by the coronavirus and on the completion of its growth strategy. And last week, the interim report on it was presented by the Commission under Professor Pissaridis, in which the moderator, Professor Vettas, is the Vice President. Prior to the COVID-19 outbreak, the Greek economy had entered a sound path of growth with promising perspectives, thanks to the implementation of a different fiscal policy mix based on the reduction of the tax burden for households and enterprises, on offering incentives for doing business and investments, on speeding up privatizations and structural reforms, which aim to boost competitiveness and productiveness. Unfortunately, this course came to an abrupt halt due to the coronavirus crisis. Thus, we are forced to open an ongoing parenthesis, which included increasing spending to tackle the pandemic and the economic and social consequences of the crisis. Greece has so far been a coronavirus success story, as confirmed by statistics concerning the expansion of the pandemic, while on the social and economic field, we have taken drastic measures to support public health, employment, business liquidity, and social cohesion. These include fiscal measures, deferrals, and liquidity measures. They were adjusted to respond to the different needs arising in every phase of the crisis. Their total value is estimated at 24 billion euros, or 13% of GDP, and may increase depending on the development of the outbreak, as well as on the available financial and fiscal space of the countries. Thus, the coronavirus challenge was swiftly, prudently, and efficiently faced by the Greek government, as acknowledged by the European Commission. This is why the Commission significantly revised its estimates for this year's recession in Greece from 9.7 to 9% in July, while its estimates for Europe and the euro area were revised to deeper recession. Apart from all the measures taken to minimize the impact of the pandemic, we are also continuing to implement structural reforms and to promote investments despite headwinds. For example, the new draft bill introducing growth-friendly tax measures just started to be discussed today in the Parliament. Among others, it includes the expansion of non-dom for foreign pensioners, the rationalization of car classification fees, the non-inclusion of shares granted to employees by the company they work for in the employee's income and the autonomous taxation of the shares betterment, the out-of-court settlement of pending tax disputes, the incorporation of a series of EU directives into national laws. In the same bill, we also introduced a bridge, a γέφυρα, a new program of high importance to support borrowers affected by the coronavirus crisis. Furthermore, other recent developments and ongoing actions in the field of structural reforms include what we have discussed with Luis at ECOFIN level, the upcoming completion of the new insolvency code with several safeguards to filter strategic defaulters in order to tackle the burden of private debt, the reduction of non-performing loans on banks' portfolios. Indeed, a systematic bank, Eurobank, has already completed the process to participate in the Hercules scheme, The new bill for corporate governance and the modern capital market, which also includes a series of measures boosting important privatizations, such as the Hellenic project and some port authorities, as well as the restructuring of state-owned enterprises and the liquidity support to businesses in the borderland. The new bill introducing microfinance, the implementation of the asset development plan, the ongoing digital transformation of the public sector, which will serve to further ease the administrative burden for households and enterprises, the draft bill for electric mobility, investments in infrastructure and the industrial field, focusing on green economy, taking advantage of all the above, completing and implementing the national growth strategy, and returning to a prudent fiscal policy with gradual tax reductions and mainly social security contributions after the crisis, we will have the potential not only to recover, but to gain a strong, sustainable, clever, and inclusive growth, which will lead to attracting important investments and creating new, high-quality jobs. It is up to us all to turn the page. I'm convinced that we have the plan, the ability, the skills, and the determination to make it. Thank you, Nikos.
Thank you, Christos. And I thought initially the Vice President was optimistic, but after hearing you, I think now we have 2 doses of optimism. Let's see if we're going to get a third one or not. Obviously, the policy response on all levels has been very important. I guess what perhaps we can discuss when we can make time for this later is how severe the problem eventually is going to be. Let me turn to the governor and see his view.
Thank you. Thank you, Nico. Thanks, ΙΟΒΕ and Konrad-Adenauer-Stiftung. Of course, Luis and Christos for excellent presentations. I think there are important developments which make us feel more optimistic today, despite the lingering and widespread uncertainty regarding the evolution of the pandemic. First, it seems that there are encouraging signs on the discovery of a vaccine. I mean, you read, I suppose, the same news that I do. Second, there are signs of recovery worldwide in the economies, as well as stabilization of financial markets, of course, partly due to the intervention of central banks. Third, there was universal monetary and fiscal, as well as supervisory stimulus to stem the recession due to the demand effect of the pandemic on the economy. And fourth, of course, there are very encouraging European responses. First, the ECB, which acted first with the PPP, now it's 1.35 trillion euros of purchases up to the end of the program. It's the TLTRO program. We already have 1.3 trillion of absorption by banks until a few days ago. We have the ECB SSM capital flexibility given to banks from a maximum of 16% capital ratio to 11.5 percentage points. So quite a flexibility, temporarily given, of course. And of course, as Christos and Louis said, we had this morning, after tedious negotiations, the European Council decision of the 750 billion euros recovery fund, on top of the decision we had on the 23rd of April on the 540 billion. So altogether, we have 1.35 trillion intervention by the European Central Bank and 1.3 trillion intervention by the European Council and the European Commission, which is quite substantial. Of course, the above mentioned measures are a step in the right direction to address the current challenges posed the pandemic, but also showing social cohesion in Europe. However, they remain temporary in nature. Looking forward, more durable improvements are needed to improve the EMU architecture. So it's necessary, since we started well, to enhance risk sharing by creating a permanent macroeconomic stabilization mechanism, either in the form of a safe asset or a central fiscal stabilization tool. Further efforts should also be made to complete the capital market union and the banking union, and I will come to that later. Also, the macroeconomic imbalances procedure should operate more symmetrically, both for member states with external deficits and for member states with external surpluses. Allow me to come to Greece. Christos made a number of points. So many people wonder why the Bank of Greece is more optimistic than, for instance, the European Commission on its forecast. As you know, our baseline forecast for this year is for a recession of 5.8%, while, as Christos said, the European Commission projects a contraction of 9% in 2020, of course, down from 9.7% in its spring forecast. So allow me to explain why. First of all, I think the number one issue is the successful containment, relatively successful containment of the pandemic in Greece. As you know, academic research, Nikos, has shown that the better a country manages the pandemic, the faster the rebound of the economy. Second, the Greek economy had already a strong positive momentum before the outbreak of the crisis. Incidentally, the projected growth rate before the pandemic was 2.4% and 2.5% for Greece versus 1.1% and 1.4% for the euro area for 2020 and 2021 respectively. These are December 2019 forecasts. Also, the growth rate of 2020 Q1 first quarter was minus 0.9% for Greece and minus 3.1% for the euro area year on year. The size of tourism is not as large as assumed by many analysts in the past. Research in the Bank of Greece shows that the direct share of tourism in GDP is 6.8%, close to other European countries of the European South. So adding the indirect contribution to GDP, the share of tourism in GDP is about 10%. We have come out to this result very recently with an input-output table of the economy. And past research suggested that the total contribution of tourism is much bigger, between 10 and 20% of GDP. So more recent analysis show that it's closer to 10 rather than to 20%. Fourth, the industrial sector has performed relatively better compared to the euro area. Industrial production in Greece has been growing faster than in the euro area since mid-2016 on average. Fifth, Greece had relatively stronger soft indicators compared to the euro area regarding both their momentum before the outbreak of the pandemic and their performance over the last months. And of course, last but not least, Greece benefited the most from the two ECB decisions, granting a pandemic waiver to Greek government bonds to be used as collateral for Eurosystem refinancing operations, and the inclusion of GGBs in the Pandemic Emergency Purchase Program, the PEPP, have helped enormously to reduce spreads of Greek government debt to pre-crisis levels, thus improving financing conditions for banks and non-financial corporations. Nevertheless, the coronavirus pandemic is expected to significantly worsen some of the legacy problems: high public debt, the high rate of unemployment, the high NPL ratio, the large investment gap from the debt crisis of the 2010s. So these problems only add to the challenges already facing the Greek economy, which constrain its long-term prospects. Low structural competitiveness, the slow digitalization of the economy, a high level of tax evasion, the brain drain, climate change, and the cost of transition to a lower carbon economy, the migrant refugee crisis, a projected demographic decline on account of population aging, and the large negative international investment position. Finally, I also like to speak on the banking system, as Luis has done. And I agree that the financial fundamentals of banks in the European Union had strengthened over the past few years on the back of favorable macroeconomic conditions and the actions taken to repair the banking system under the supervision of the SSM and the national competent authorities. Banks have significantly increased their capital buffers and made significant progress towards improving the asset quality. In December 2019, the EU average common equity tier 1 ratio was 15%, that is 2 percentage points higher compared to 2015. Whereas the non-performing loans ratio was 2.7% compared to 5.7% in 2015. However, and as we said, even before the pandemic, the EU banks faced significant challenges, such as low profitability on the back of the persistently low interest rate environment and lingering cost inefficiencies, fragmentation in the European banking system, disruptive technological changes, and overcapacity in some banking systems. At the same time, and despite the progress at the aggregate level, some banks, especially in member states of the EU periphery, were still on a recovery mode, trying to address legacy issues, notably the high level of non-performing loans. And of course, Greece is one of these member states. In the Greek financial system, the developments before the pandemic were quite benign, with improving capital adequacy ratios, profitability, and liquidity. The NPL ratio, of course, of Greek banks was the highest in the European Union, but in the last 3 years, and until December 2019, the NPL volume fell significantly by about 39 billion euros, from a peak of almost 107 billion in March 2016, mainly through write-offs and sales of loans. However, the pandemic and the subsequent deterioration of the economic environment was the perfect storm for the European banks, affecting them across most business segments and disrupting significantly their operational capacity. The national and European authorities acted swiftly, introducing, as I said before, unprecedented measures in order to mitigate the impact of the pandemic. These measures were in the right direction and alleviated the short-term pressure on the liquidity and capital position of banks. However, according to the experience from past crises, such as an acute economic recession, is highly probable to impair the asset quality of lenders. Today, just a few months after the lockdown, it is still too early to assess the impact from the pandemic on European banks for several reasons, mainly 3. First, there is still uncertainty about the medical factor, while there is a wide range of projections for economic activity, a key determinant of banks' credit losses. Second, there is usually a time lag between worsening macro variables and the emergence of new NPLs. The loan moratoria and the state support measures increase this time lag, but at the same time, they contribute to higher uncertainty in the medium term. For example, the deferral of loan amortization payments is an effective measure to address borrowers' short-term difficulties caused by the pandemic, but could potentially create a cliff effect upon the termination of measures. Third, some banks that were already in a fragile position before the pandemic may have to struggle more than their peers to navigate through the crisis. For the Greek banks, even during the pandemic, many indicators develop in a rather benign way. Liquidity, deposits, higher deposits also reflect higher savings, both are precautionary and due to the lockdown. pre-provision income, cost-to-income ratio, etc. However, a potential creation of a new generation of non-performing loans could hamper the efforts of Greek banks to clean up their balance sheets. Greek banks are already in the process of making use of the Hellenic asset protection scheme. We encourage that. Nevertheless, this action may not be enough, given the volume and the legacy of NPLs and also the creation of new ones. So we believe that it's necessary to implement additional systemic solutions complementary to the efforts of banks for the rapid improvement of the quality of their assets. In this context, the Bank of Greece is currently working on a proposal to set up an asset management company, which, along with the NPL problem, will also deal with the issue of capital quality due to the high share of deferred tax credits in Greek banks' balance sheets. So recently, we selected through an international tender process 3 out of the top-tier investment banks and advisors with experience in this field that will assist us in all aspects of the scheme. I would like to conclude my intervention with a tone of optimism. John Kennedy once observed that when written in Chinese, the word crisis is composed of 2 characters. One represents danger and the other represents opportunity. I always believe that opportunities may arise out of a crisis, and I truly believe that Europe will emerge stronger from the current one, and today's decision is a witness of this. I think now it is the perfect time to make bold steps to strengthen as well as to complete the missing parts of the banking union. This includes the introduction of the missing leg of the banking union, that is the Pan-European Deposit Insurance Scheme, the improvement of the EU Recovery Resolution and State Debt Framework, the improvement in the macroprudential framework, and the reduction in national options and discretions in bank supervision. I think that the completion of the banking union will allow us to avoid the creation of another bank sovereign nexus, especially in light of the significant fiscal support provided to the economy and banks by all member states and the European Union. Thank you.
Thank you, Governor. Yes, and you ended your initial remarks with a good dose of optimism, although you did highlight all the problems that we currently have. Let me start this discussion. I would suggest we organize this perhaps initially in 3 rounds. First, I have some worries about what we can call the real economy and what we can do about it. Then perhaps we can talk about the mix of monetary and fiscal policy. Then think a little bit more about what the governor now described as banks at the European level, and then Greece, and especially performance of loans. But let me start a little bit about, as I was listening to everything that you all 3 said, I was thinking a little bit also about the management of expectations and how expectations should be shaped during this crisis, because it is a crisis. And the European economies and the global economy, for that matter, is being hit very hard. So businesses are going to feel this. Households are going to feel this. It is a difficult reality, and despite all the efforts, despite all the policy responses, is the average European company and is the average European citizen and voter ready for a couple of years that, despite the policy responses, will likely be difficult? Perhaps should we be a little bit clearer in terms of the difficulty ahead, unless the news is such that perhaps the vaccine, perhaps that Europe is standing united, that in a few months we can think that the problem will be behind us. So how should we think about this? Is this a problem that is here to stay? And just to add one more thing about distributional effects. This is not a crisis that is hitting everybody the same way. And I'm thinking about distributional effects with across European economies. Perhaps the strong ones will come out of this stronger, and the weak are going to get out of this weaker. But also within countries, it looks like this is a crisis that, especially when it is hitting a number of areas of employment where lower income households are normally employed, this may have very strong distributional effects in incomes for our whole continent, but within a country like Greece. So I'm worried both about the effect of the crisis, the recession, but also about distributional effects. I don't know if any of you would like to start on any of this.
You choose.
Well, I will start from the Vice President. Luis?
I'm going to, I suppose that I am mute, that I have unmuted now. Well, I think that you have made good points, Nikos. First, well, you have said that we are optimistic. Well, and the first thing that I have said is that our baseline scenario is a decline in GDP in 2020 of 9%, and that it will take, at least 2 years to go back to the pre-crisis income level. So, well, I think that we are more or less, I think that, this scenario, it could be worse, but it could be better. I have never seen in my life such a crisis. I think that is the deepest crisis since the end of the Second World War. And this is something that we have to bear in mind. And I think that there is another element that we have to take into consideration is the level of uncertainty, because there are exogenous variables. The discovery of the vaccine, the evolution of the pandemic, the possibility of a second wave. These are elements that are beyond, the control of finance ministers or central banks. My personal impression is that, when you put all the intelligence of all the research, labs in the world in order to find out, to discover a vaccine, I suppose that, it will take longer than usual. And I hope, and I am hopeful that, in 1 year time, we will have a remedy for this illness. No? But this is something that is beyond my control. I am not a specialist on that kind of things. No? But, now the outlook is, I would say that it's quite bleak. A drop in GDP of 9%. I have said that perhaps, in the second quarter, instead of a decline of GDP quarter on quarter of 13%, we are going to have something that is going to be slightly better. But there are a lot of question marks, a lot of uncertainty with respect to the evolution in the third quarter and the fourth quarter. And I think that the dynamics of the labor market, once the furlough schemes are over, is going to have, a real impact. You have also mentioned something that, in my view, is quite relevant: is distributional effects. And I think that there are different angles that distributional effects can be analyzed from different perspectives. The first one is, that not all the industry, not all the sectors are going to be evenly hit by the pandemic. For instance, the obvious example is, tourism. Tourism is going to suffer quite a lot, mainly if we start to see that there are, a new wave of outbreaks, in some areas, in some countries that, receive a lot of tourism. So, from an industrial standpoint, from a sector analysis standpoint, the impact is not going to be evenly distributed. There are some sectors that are going to suffer much more than others. And I think that, there are another perspective of the distributional effect. That is, the personal, the household the impact that the pandemic is going to have, in terms of the distribution of income, the distribution of wealth among the different households in one country. And I think that here the key point is going to be, let's say the digital divide. Not all the households have, a similar capacity to be connected. And I think that the digital world is going to become one of the consequences of this pandemic is going to be that, the digital component is going to become more and more relevant in our life. I refer to not only to retail commerce. I do not refer only to business. I do not refer only to entertainment. I refer as well to education. To all the aspects of our daily life are going to be affected because of the digital revolution that we are going to suffer. That has been accelerated because of the pandemic. And I think that not all the households have, the similar capacity and the capabilities in order to be connected and to take advantage of this digital revolution. And finally, you have mentioned, disparities and, the possibility of having the different speeds in terms of, the performance, the national performance of the different countries. And I think that it has to do with the way that the pandemic has been dealt with by the different governments. In that respect, I think that the Greek government has made a very good job. If you look at the numbers in Greece, I think that really is impressive. How the government has addressed the sanitary problem, and when you compare the outcome of Greece with other countries, Greece is second to none in terms of dealing with the pandemic. But as well, it has to do with the composition, with the structure of the economy, and with the fiscal space available for each country. And in that regard, not all the countries have a similar situation. They do not have the same possibilities. Fiscal space is not evenly distributed. There are some countries, for instance, Germany or Netherlands, that they had a fiscal surplus with a public ratio below 60%, and there are others that are clearly above 100% with a fiscal deficit that was in negative territory. So that's why I think that the agreement that was reached yesterday is so important, because it puts the different countries in a much more, let's say, level playing field in terms of the fiscal response, and it could avoid fragmentation, because different fiscal responses could give rise to fragmentation in the euro area, in the union. And I think that in that respect, perhaps from my standpoint, the main positive component of the package that was agreed yesterday is that it's going to be an important helping hand for those that were in a situation of disadvantage vis-a-vis other countries that had a better fiscal position. So
I guess we will all agree that the agreement of this morning is important. But just one word: do you think it will prove enough?
Well, I think that it's what we have, and the size of the package is huge. It's not comparable to what it was agreed in the past. Compare the response to this crisis with the response of the crisis that we had in 2010, for instance. And when you put together the monetary response, the monetary policy response, plus the national fiscal packages, plus what was agreed last night, I think that it makes a very clear difference with respect to the past.
It is a significant sum of money. Can I turn either to the minister or the governor and insist a little bit on this, how expectations should be formed in Europe? Because as Luis just emphasized, yes, we are doing a lot, but this is a very serious problem. And are we ready to get into a couple of difficult years and perhaps
May I?
Sure.
Can I take the floor? Thank you. Thank you, Nikos. First of all, on the word that you referred before, if what was decided today, yesterday, it's enough. I totally agree with Luis. The combined response, the balanced policy mix between monetary and fiscal policy is enough. Don't forget that we have already taken bold decisions, not only on the fiscal side, but also on the financing of the fiscal policies, but also on the monetary side. I repeat, if we add what was decided recently on EIB, on the SURE program, and on ESM, with what was decided today, the total amount of money reaches 1.3 trillion euros. What Ms. Lagarde and Luis mentioned many times at the Eurogroup and the ECOFIN level. So the combination of all these policy responses, as well as the relaxation of fiscal rules and targets, are vital in order to tackle the economic and social consequences of the crisis. A crucial question is how you fuel all these expenses. And in Greece, the Ministry of Finance managed domestic resources with prudence. We continue to have a cash buffer of around 30 billion euros. We are successfully borrowing from the markets, either GGBs, 5 billion euros during the crisis, or T-bills, an additional 2 billion euros amount of T-bills. We execute the budget in the best possible way, and finally, we are ready to use, to the best of our ability and on the right time, the existing available European financial instruments. The third point that you mentioned has to do with expectations. We have to be honest. And at the same time, we have to present the situation on a realistic basis. We make clear the difficulties ahead many times in our interventions in the Parliament or outside the Parliament, either the Prime Minister, the Minister of Finance, or other colleagues. So it will not be an easy period ahead. However, we have a competitive advantage because recently, as a society, as a Greek society, we faced huge difficulties and we made huge sacrifices. So we are familiar with similar difficult situations, especially nowadays that we have exogenous and symmetric shocks. Regarding expectations, we have to proceed and implement structural reforms and, of course, fiscal measures in order to enhance expectations, but realistic expectations. So we try to present positive figures when they are available and they represent the reality. For example, Greece's economic sentiment indicator stands at higher level compared with the Eurozone. This has to do with the expectations of the society. Let's move to the expectation of investors. Recently, an EY attractiveness survey Greece 2020 project was published, and they say that 38% of investors consider that Greece's image as a possible destination for improvement has improved over the last year, over the last months. 69% of investors expect further improvement in the next 3 years, and 62% think that Greece is following an investment-friendly policy. So we have to create expectations, but take into account the policies that have been or will be implemented. And final comment, distributional effects. You are right. There is a danger in the country and among the several and different member states. This is why we have taken specific, quick, decisive policy responses in tackling this problem. For example, the special allowances for employees and self-employed, the employment support measures, especially for seasonal companies, or even the refundable advance payment in order to support business liquidity for smaller companies that cannot attract liquidity through the banking sector are important ingredients in this holistic approach in order to reduce, as possible, the distributional effects that we mentioned before.
Governor, would you like to comment on any of this?
Many. First of all, uncertainty still remains the name of the game, I think. Despite the good recent phenomena we have on soft indicators, recovery worldwide, slow, but definitely a recovery. On optimism, you have to take into account that in Greece, the prospect for 2020 was for a positive growth of about 2.4%. So if we depict a negative forecast for this year of minus 5.8, we don't differ too much from the European Commission of 9%, because if you add a 5.8 with a 2.4, that was the initial forecast, and I think they were very, very common among forecasters, that makes 8.3. So we don't differ too much. So it's not, you have to take into account that Greece was on an upward growth recovery path. On distribution, you're right. Here, it is a very important problem. I mean, for those of us who believe in Rawlsian theory, and we care about those at the lowest end of the income scale, the low-skilled workers, yes, it seems that the pandemic will increase inequality. Of course, if you take into account the effect on asset values, that might be a different thing. But prima facie, and but of course, many researchers will devote a long time on that. Prima facie, I think that the pandemic will increase income inequality, I'm afraid. On the effects of the real economy and the future path, a lot will depend on whether people will spend their savings this year or next year. As I said before, we have a very high rise in the savings ratio. This is also shown in the deposits in Greek banks and in European banks and in other financial instruments. So the question is, will people feel more comfortable to start spending these savings now, or will they keep it for the future? Nobody knows. If there is progress in the vaccine, as we all think there's going to be, then we are more optimistic that these savings, this increase in savings will become consumption. So we might have a V-shaped recovery. And next year, we might have a growth number which is similar to the negative growth we have this year, a V-shaped recovery. It is very encouraging. I think this is mostly encouraging, what happened this morning. At last, for all of us, that we gave a battle throughout our involvement in the public sphere to convince all member states to agree on this common action. This became reality today. Of course, the ECB has done it before, but this is another story. It is important on the European Council today, and the decision of April, put together 1.3 trillion on the table. It's extremely important for that, for the cohesion and also for the expectations of people. And politically, if we look at it, it's a defeat of populism. Many people, populists, would like today to have a failure, but we have a victory. This decision is extremely important. I hope that it will continue. This common action will continue as far as the banking union is concerned, as far as capital union is concerned, as far as financial stability issues are concerned, macroprudential flexibility. I mean, we have too many constraints today, BRRD, state aid rules. It's time now, and this crisis is an opportunity to start rethinking on macroprudential and financial stability policies. I gave some indications, and Louis also. So it's time now to start having a proper dialogue on these issues, because without banks being able to provide credit to the real economy, I don't believe in theories of creditless growth. And I think you too. I fully agree with Luis and Christos. Distribution is not only within countries, but is also across countries. Fiscal space is an important consideration. And this is why today's decision was very important, to alleviate the problem of fiscal space in countries that they don't have it. And the pandemic is an extremely strong alibi to take this kind of decisions, so that you take into account that there is asymmetry in fiscal space. Also, the same must be in state aid rules. It's extremely important that there's a fair distribution of state aid now. Finally, member states, now the ball is in the member states' playgrounds. Member states should build the necessary infrastructure in order to absorb these 1.3 trillion euros in a satisfactory way. Thank you.
I think you have all touched upon some really important issues that are going to play out for the next several months. But let me add two concerns I might have, and ask you if you may, to alleviate these concerns a little bit through your thoughts. So, starting, I guess, with the Vice President, and then with everybody else. One concern is about the limits of monetary policy. So monetary policy has been walking on this line on unconventional for some time now, even before COVID ever arrived. We had discussed this actually already in Athens in February. And I think all of us, we said, well, and what if something happens? And then something happened. So we are getting into this with actually some history in terms of monetary policy. And how is this going to be in some sense undone? And how is this going to continue over the next couple of years? That's one question. The second question, because all this is related, is should I be worried about the level of debt, the level of national debt? In the periphery countries, countries like Greece, countries like Italy, however, larger economies, the level of debt is increasing. Of course, it's kind of technical this year because of the GDP shrinking, but it is growing. And public debt is also growing overall in Europe. Are we building towards a debt crisis, especially if prices are going to be very low and we cannot even monetize 2% of that every year? So these are my two concerns about, where are we heading with monetary policy, and then thinking about public debt. Sorry that these are two kind of thorny questions.
Well, Nikos, I think that you have made two good points, and two elements of concern, and for sure, at least if not concern, of increasingly higher attention, I have to say. Well, first of all, I used to say that monetary policy is not almighty. We do not have the philosopher's stone. That's something that is quite obvious. But there is something that is, and this is a fact, when the pandemic, that was not, in February, remember that we had some discussions about the pandemic in China and the level of uncertainty affecting markets, but we didn't expect such a shock at all in February. But what I have to say is that we were able to react. We immediately, increased the liquidity and the conditions of this liquidity and the pricing of this liquidity for the banks, the liquidity that we granted and we provided to the banks. Secondly, we launched our pandemic program with a size of 1.35 after the second expansion of the program of 1.35 trillion euro. That I think that is having an impact in on the market conditions. And finally, from the prudential standpoint, we alleviated many of the limitations of the banks, and it's working. We have seen that despite the fact that the crisis was extremely profound, that it was a slump. Well, markets have started to be in a much more normal situation than they were, at the beginning of the pandemic, and at the end of March, the beginning of April. So, in terms of the financing conditions of the economy, our actions have been working. That's so far, and I hope that that will continue being the case in the near future. So. Always we are going to have discussions about the limits of monetary policy. My point, I remember, when we had, this gathering in February, is that, monetary policy has to be accompanied by fiscal policy. And I think that it has been the case now. So we are not only, the ECB is not the only game in town. And, we are able to come out with, additional programs that really have worked in terms of avoiding a tightening of financing conditions and avoiding a credit crunch. That's something that is important to take into consideration. And your second question is about the level of debt. I think that in the short term, the only alternative that we have is fiscal stimuli. I think that at the national level, at the pan-European level, is something that is going to be there. There is a very positive, element of the package that was agreed last night. Is that an important part of the transfers are going to be grants, no? And this alleviates the debt problem of some countries that have very limited fiscal space. But in the short term, it's quite obvious that fiscal policy has to be expansionary. We have to respond. There is an unprecedented drop in terms of revenues, in terms of income of the private sector. And I think that the public sector has to jump in and to try to fill that gap in order to make to maximize the number of enterprises that are going to survive to the confinement and to the period of lockdown. Once the pandemic is over, once the situation has stabilized, for sure that we will have to pay attention to fiscal sustainability. It's something that is going to be there. But at the moment, taking into consideration the present situation, I think that the only response has to be fiscal expansion, additional public expenditure, declines in revenues, because automatic stabilizers are going to work, and it's not only the discretionary fiscal stimuli that is going to be implemented by the different governments. We will come out of the crisis with a higher public debt level that will be a legacy of the crisis, and we will have to deal with this situation once the pandemic is over and once the slump has been corrected.
Okay, thank you. On the same dual topic of limits of monetary policy, have we exceeded them or will we exceed them? And then on public debt?
Sorry, Yannis, please.
No, Christos, let's keep the order.
It's fine. You can answer on the monetary policy.
Yes. Okay, do you want me to start on the monetary policy? I agree with Luis. First of all, monetary policy definitely is not almighty, and we are glad today that fiscal policy became a twin. That's what we said in February, and that fiscal policy should also take a burden, that monetary policy cannot do everything. It cannot do the only play in town. So fiscal policy now has responded, both at the national level and especially at the Central European level. This is extremely important. Second, the level of debt. Of course, it is a concern, but there is no alternative. There is no magic way that we could have tackled the pandemic. We should minimize the recession, and also have no impact on public debt. There is no magical solution. Of course, as we said, when the pandemic is over, we have to be careful to look again at fiscal sustainability. There must be a slow return to normality. I think we should not rush here on the questions of public debt. On monetization, inflation is still very low, very low. It's 1% or even less. We are far away. I mean, in Greece, it's negative. We are far away from the close to 2% target. So we don't have to worry about inflation now. If anything else, it is the other way around. Commodity prices are down and continue to fall. So I mean, there's excess capacity in the economy due to the recession. We don't have any evidence of higher inflation, albeit a very, very small return to our target. But this, it seems, it will take time. So common sense says that we should not worry about these things. And the path we are taking, both on the monetary and the fiscal side, is the correct one. I think it is extremely important that this morning the European Union took this decision, because otherwise this 1.3 trillion would have fallen on the shoulders of individual member states, and that would be perhaps impossible to deal with. Thank you.
Before the minister addresses these issues, perhaps let me fine-tune the question on debt. If he would like to add a couple of thoughts about the trajectory of the Greek debt, how it looks now for 2020, how things are going to look for 2021, including perhaps projected deficits. Should we be worried, or are things under control?
Nikos, I will going to have one more round of questions because I would like to make a comment on the Greek banking sector.
Yes.
So I will complete with that, but let's start with public debt. I think you have said, and I will split your question in two: the level of debt and the sustainability of public debt. Definitely, debt will increase, and the sustainability of debt will deteriorate, both due to the denominator, the need to implement expansionary fiscal policies, but also due to the denominator, due to the fact that it will be in deep recession, all European countries. But I agree with Louis, it seems that it will be short-term. And don't forget that all European countries have low cost of funding until now. And most probably, they will continue to have low cost of funding. Moreover, I will remind you that Yannis and me supported the view from 2012 onwards that the effect of the denominator on debt sustainability is much larger compared with the numerator. This means that 2/3 of the improvement in the debt sustainability is coming up from GDP. And it seems that we will have in Greece and abroad strong rebound in 2021 onwards. So regarding the level of debt, it will increase, but we don't see on the baseline scenario a significant deterioration on debt sustainability, even in Greece. And this has been supported by the ESM when we discussed at the Eurogroup level the ESM pandemic credit lines. And don't forget, and we should take it into account, that the profile of Greek debt is much better compared with our counterparts regarding the annual financing needs and the holders of Greek debt. This is why I think that the sustainability of Greek debt is under control. And if I may comment on what Yannis mentioned before regarding the Greek banking sector, you would like to make it now,
actually,
or
let's make this our final round of questions because we are running out of time, but with the reverse order this time. So you start this round and commenting on Greek banks.
Okay, I agree, and I have shared my views with the Bank of Greece and the institutions that the challenges for European and Greek banks are ahead regarding profitability, asset quality, funding, liquidity, capital adequacy. We cooperate closely and productively with the Bank of Greece and institutions to tackle all these challenges. We are open, as Yannis mentioned before, for realistic, innovative, and efficient systematic solutions so that Greek banks Greece will eventually approach single-digit NPL ratios, taking into account, however, the fiscal impact, prudent treatment, state aid conformity, and market attractiveness. Thanks.
Governor?
Well, I agree with Christos. We are in close contact, trying to find out solutions that will at the same time deal with two lingering issues, which is the volume of NPLs. I mean, unfortunately, in Greece, it's not so much the pandemic NPLs, but the legacy of NPLs. The legacy of NPLs is already 37% of the total. So whatever the pandemic adds, it's going to be miniature compared to the legacy NPLs.
Can I get in the middle with a very direct question? Why has it been so difficult, the NPLs problem to handle over the last, 5-6 years now?
Well, it's a number of factors. First of all, it was the recession. Negative growth rates produce new NPLs. High unemployment produces new NPLs. Unfortunately, we had the kind of legislation that did not contribute to reducing NPLs. Now, Christos and his team are preparing new legislation on that in order to improve the payment culture, what we call the payment culture. It is important. I mean, what I mean in practice is not let the strategic defaulters go away, because then everybody else is paying the bill. This is extremely important. And I would say that the payment culture is more important compared to any other scheme, whether it's the Hellenic asset protection scheme or an asset management company. I think number one issue is the payment culture, so that we don't create again a mentality of strategic defaulters. But I think what I was saying before is that there are two problems in Greece. It is not only the high NPL ratio, it's also the DTC problem, the deferred tax credit, which is a difficult problem. Perhaps it was a blessing during the crisis before, but it is a curse now because it does not allow the Greek banks to become very investable to the extent that they have a high percentage of DTC in their own capital. So what we are trying to do with our advisors is to tackle both problems together. When we are ready, we'll present this to the government, to the SSM and the European Commission. And I hope that by assembling all the technical capacity of the Bank of Greece, SSM, and also advisors, foreign advisors, the three ones that we have selected, will be able to satisfy all the stakeholders, the European Commission, the Greek government, and the SSM.
Nikos, sorry for the intervention, but in order to add what you asked before regarding the last 5 years, don't forget that, yes, indeed, we have to take much more bold actions in order to reduce to single-digit NPLs. But since March 2016, we have reduced NPLs by 43.6%. It's a significant reduction in the last 4 years.
I guess most people would agree with what you just said. But at the same time, I think looking ahead, unless we run even faster, putting money into the new real economy is going to be very hard. So at least I understood the governor's view that even if we are in the right direction, we should run faster. Governor, isn't that the view?
Yes, much faster.
Agree on that.
Okay, so we have two agreements. Vice President, you have the last word. If you could include perhaps a couple of thoughts on exactly this issue, the role of banks for fueling liquidity into the economy, supporting existing companies, but also new investment. In Europe, we have banks, perhaps some may say a little bit more at the center of our economy than in the US or in Asia. Can we do something so that our banks help fuel more dynamism into our economies?
Well, you are totally right, Nikos, that the European economy is a bank-based economy, especially for small and medium corporates. That's something that is key, in comparison with the United States, for instance. In the case of the States, the market-based funding of the economy is much more relevant. So what happens with the banks is going to be crucial. I made the point with respect to profitability. Profitability is my main concern. Is the main vulnerability of the European banks. So I think that consolidation is the way forward. As I have said before, we need to improve the profitability through the reduction of costs, through the elimination of excess capacity, with an improvement in revenues. And I think that consolidation could be a very useful instrument in order to do that. Let me say something. In the next days, we are going to finalize, the vulnerability analysis. The vulnerability analysis of the European banks is an exercise that is going to replace the stress test. The stress test was deferred. And you will see that the first line of defense of the European banks, in order to withstand, the shock of the pandemic, is going to be the high level of capital that they have, they had at the beginning of the crisis. With a capital ratio that it was close to 15%, the situation is totally different, and the capacity to confront, this a shock as this one, I think that is, has been quite, has been improved dramatically, with the high level of capital that the European banks on average have now. And finally, let me say something that I think that is relevant. We do not have a completed banking union at all. We do not have the scheme. We do not have it. I think that we should pay attention to that. We are happy, and I think that we have reasons in order to be happy because of the program that has been approved. But I think that the architecture of the monetary union is not complete. Banking union is not complete. I think that we have to make additional progress in capital market union. And even I hope that, after last night agreement, we will start to work in a sort of pan-European fiscal instrument in order to accompany monetary policy in the future and to have a real, completed architecture and institutional framework for the euro.
Thank you very much. I think we had a convergence on a lot of the issues. And then each one of you also flagged issues that might be of particular concern over the next year or two. I would not like to take any more of your time because it is extremely valuable. You all have work to do. I would like to thank you. I think this was a useful discussion, so useful that I guess perhaps we can make this institutional. Maybe we can come back to this in a few months. And as Vice President, you said at the start, perhaps, hopefully, we can do it physically in Athens. Let me see if anyone would like to add a final word. Minister?
I'm fine. As was proved once again, Yannis was much more optimistic compared with me.
Okay.
It is
Governor?
it's a question of DNA, I think. It's, no. Well, I wish we all have good holidays, stay healthy, and Louis will meet in Frankfurt, I suppose.
In September.
Physically, after many, many months, in September.
So, Christos, you know perfectly that central governors are always, happier people, huh? Than ministers of finance. So, and so they have a tendency to be more optimistic. No, yeah, I wish you all the best, and next time for sure, Nikos, that I hope that we will be able to have this gathering, physically in Athens. That will be my great pleasure.
Okay, thank you all very much for your time and especially for your contribution and ideas. Thank you all.
Thank you, Nico.